while being slightly fast-paced. The stock market is currently closed, but as of the last close on Monday, October 13, 2025, SoFi Technologies Inc. (SoFi) ended the day at a price of $27.14, reflecting a modest gain of 3.63% from its previous close. Now, the common expectation is that this movement is just another volatile day for a high-beta fintech, a blip on the radar following its major rally this year. But here's the unexpected insight, the deeper truth you need to understand. The modest daily rise isn't about retail euphoria or market noise. It's a quiet reflection of an accelerating institutional conviction that SoFi is successfully transitioning from a volatile growth play to a sustainable, diversified financial institution, a financial super app backed by its bank charter, something that fundamentally changes its risk profile. The market has largely priced in the idea of profitability, but it hasn't fully digested the operating leverage that the full vertical integration of its bank charter, its technology platform, and its diverse product suite is finally unleashing. This is the tension between expectation and reality we must explore. The general market narrative surrounding SoFi is one of a fintech disruptor that managed to survive the high-rate environment, successfully pivoting from a student loan refinancing pure play into a broader financial services platform, a one-stop shop for a younger, more technologically savvy demographic. Investors have been laser-focused on the company's membership growth, which has been nothing short of explosive, and the achievement of GAAP profitability earlier this year, a significant milestone that set it apart from many of its early-stage peers. The common belief is that the stock is now on a strong uptrend, but the valuation, trading at a premium compared to many established banks, is constantly a point of contention. The prevailing thought is that the next leg up depends almost entirely on the looming Q3 2025 earnings report, scheduled for the end of October, and whether it can maintain its streak of beating analyst expectations. This is where we challenge the surface-level narrative. The reality, the contrarian and deeper take, is that the recent upward pressure, particularly the solid closing price of $27.14, is less about the retail frenzy and more about a calculated, quiet accumulation by institutional money managers who are looking beyond the next earnings print and modeling out the long-term impact of its unique tri-segment model: lending, technology platform, Galileo, and financial services. The average daily trading volume for SoFi remains robust, having recently seen spikes well above its 3-month average, which, combined with institutional ownership percentages hovering around the 50% mark, indicates significant professional involvement. These institutions aren't just betting on a loan book, they're betting on the stickiness and cross-sell potential inherent in the financial services segment, where non-lending products like SoFi Invest, the SoFi mobile app, and its checking and savings accounts drive high-margin, sticky revenue. This is the core thesis. The long-term value of SoFi isn't primarily in its lending business, as many critics suggest, but in its ability to become the central intelligent portfolio hub for its affluent, high FICO score customer base. The acquisition of a bank charter has dramatically lowered its cost of capital, providing a moat that pure-play tech companies in the financial space, like early-stage Robinhood or even elements of Interactive Brokers' retail focus, simply don't possess. This capital efficiency is what will ultimately bridge the valuation gap with traditional, albeit much slower-growing financial giants. Looking closely at the recent stock movement, the daily swing from the open of $27.07 to the high of $27.43 before settling near the top of the range is a bullish technical signal. The stock has successfully defended crucial short-term support levels near the $26.50 mark, showing resilience even as the broader financial sector faces macroeconomic pressures from persistent inflation and the Federal Reserve's ongoing interest rate policies. High interest rates are a double-edged sword for SoFi. On one hand, they increase the cost of borrowing for the general population, which theoretically makes their personal and student loan products, which target a lower-risk borrower, more appealing due to better rates. On the other, they increase the company's own funding costs outside of its deposit base. The lending segment's ability to maintain excellent credit quality, with the average FICO score of its personal loan originations consistently in the mid-700s, has been key to insulating it from the rising delinquency fears plaguing some subprime lenders. The market is recognizing this credit discipline, and the stock's performance reflects a premium on that quality. The true differentiator, and the part of the business that consistently exceeds expectations, is the technology platform, powered by Galileo and Technesis. This is SoFi's infrastructure play, providing core banking and payment processing services to other fintechs and traditional institutions alike. As other financial companies attempt to rapidly digitize to compete with players like Fidelity or even the retail arms of major banks, they need modern core infrastructure. Galileo is essentially the picks and shovels of the digital gold rush, and its revenue stream provides a significant high-margin diversification away from credit risk and interest rate volatility. The market segment has consistently demonstrated high teen to low 20% revenue growth, often exceeding internal forecasts, suggesting that the B2B side of SoFi is a powerful, undervalued engine. SoFi's core business model is a vertically integrated financial supermarket built on a single user-friendly platform. It has three main revenue streams. First, the lending segment generates interest income from personal, student, and home loans, and gains from the sale of those loans. Second, the technology platform generates fee revenue by providing its Galileo platform for payment processing and account services to other fintechs. This platform is a critical yet often overlooked asset that powers competitors like Robinhood's cash management feature or other challenger banks, showcasing SoFi's pervasive influence in the space. Third, the financial services segment, which includes SoFi Invest for self-investing, checking/accounts, and insurance, generates fee-based and net interest income. The long-term vision is to use the low-cost, high-engagement checking savings product to acquire members and then seamlessly cross-sell them into high-margin lending and online investment products, effectively boosting the customer's lifetime value. This model is a direct challenge to the legacy structures of institutions like Fidelity Investments, which, while massive, often operate with more segmented product silos. Historically, the company has seen explosive member and product growth, turning a high customer acquisition cost into a much lower one through its successful cross-selling strategy. In terms of the future outlook, the expectation versus reality dynamic is critical. The market expects continued profitability, primarily driven by the lending segment's performance. The reality is that the biggest future catalyst lies in the exponential scaling of the financial services segment. Management has set an ambitious long-term goal of $1.2 billion in financial services net revenue, which, if achieved, would signify a massive shift in the company's revenue mix away from the capital-intensive and cyclical lending business. Potential catalysts that could propel the SoFi stock higher include the student loan moratorium ending, which would drive a surge in refinancing originations and a return of the company's original core business, the continued expansion of SoFi Invest products, like its recent rollout of more sophisticated options trading to directly compete with Robinhood stock trading and interactive brokers platforms, and, most crucially, the sustained growth of the Galileo client base, which represents a highly scalable, almost entirely variable cost-free revenue stream. However, the risks are substantial and must be factored into any deeper analysis. First, the valuation remains elevated, meaning any miss in earnings or a slowdown in member growth could trigger a sharp correction, forcing a rapid reevaluation of the premium. Second, credit risk is a perpetual concern. While the underwriting quality is strong, a broader sharp economic downturn, a reality in a high-rate environment, could lead to higher-than-expected personal loan delinquencies, necessitating increased loan loss provisioning, which would crush GAAP profitability. Third, regulatory scrutiny in the financial sector is intensifying, particularly for fintechs and digital banks. Any adverse ruling or new legislation could negatively impact the cost of deposits or lending practices. Ultimately, the authoritative perspective remains centered on the theme of vertical integration. SoFi is not just an online investing platform, it is a full-stack digital bank with a powerful B2B technology arm. This comprehensive model gives it the necessary tools to navigate market cycles and compete against both old-guard institutions and new-age fintechs. Its ability to offer an end-to-end digital banking experience, from simple invest online features to complex lending, positions it uniquely. The stock's recent resilience at $27.14 suggests that the smart money is starting to internalize the long-term structural advantages of its bank charter and technology platform. It's no longer just a narrative about growth, it's a measurable execution on becoming a major financial pillar. The real question is how quickly the market consensus catches up to this institutional reality. Before we conclude, I'm curious to hear your personal experience with these platforms. Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you prefer a traditional broker like Fidelity or a new age platform like Robinhood for your self-investing needs. In summation, the expectation that SoFi Technologies Inc. is merely a high-volatility consumer